Now, we're currently navigating our sixth consecutive year of a structural global supply deficit. By the end of this year, we project a shortfall of roughly 67 million ounces. But the more alarming metric is the cumulative drain. Between 2021 and 2025, this market consumed over 820 million ounces, which is more than it produced. We've essentially burned through an entire year's worth of global mines output just to keep the lights on. This is happening because the market is caught in a vice grip between secular, unstoppable demand and highly inelastic supply. If we talk about the demand side, we're running roughly 1.2 billion ounces annually. This is no longer about jewelry and retail coins, but industrial fabrication now accounts for 60% of that total. Solar photovoltaics alone are consuming over 20% of the world's silver, and the massive build out of high voltage AI data centers is creating an entirely new price inelastic floor for the material. On the supply side as well, the engine is basically stalled. Global mine production is flatlining around 820 to 840 million ounces, and because 72% of all silver mined is basically mined as a byproduct of base metals like copper and zinc, the supply side is structurally deaf to the silver price. You can basically double the price of silver tomorrow, and a copper miner will not spend $1 billion to expand their operations solely to account for that silver credit. So joining me today to share their perspectives on this silver narrative is Jeff Sundar of Capital Markets Advisor. He's the Capital Markets Advisor of Aftermath Silver. Greg Johnson, Chairman and CEO of Metallic Minerals Corp. Darrell, Rader, President and CEO of Minaurum Silver Inc. James M. McDonald, President, CEO and Director of Kootenay Silver. And Peter Krauth, book author of The Great Silver Bull. Welcome to the show, everybody.
Thanks for having us.
Thanks.
It's good to have you all on. So, talking about the silver industry, it's basically surviving by draining above ground inventories on the COMEX and Shanghai exchanges, basically to multi-year lows at the moment. But you can't run a structural deficit forever. So, Peter, the buffer seems to be gone. The market is in deep backwardation, and the only way out of this seems to be either a violent demand destruction through like a price discovery, or potentially the capitalization of some really high quality big silver projects. So which one of these do you think is more likely, or do you think there's another way out of this?
So, it's interesting that you're right. Absolutely. I've been saying this for about 2 years now that and until about a year ago or so, the reason I felt that the silver price seemed to be almost capped was because we had these above ground inventories. So previous years of production that had accumulated were on these futures exchanges, and the big consumers were able to go out and buy those silver ounces, gradually drain those inventories and not put pressure on new supply. And I said that we had about 12 or 18 months for that to play out, and it looked like it was about that amount of time, because from about the summer or so of last year, things really started to take off. And there's always been the pushback, the argument that silver will come out of private hoards, private holdings, if the price gets high enough, and ease some of those supply concerns. And I had always said that it was not going to happen at $30 or $40 silver. It would take $50, $60, $70 silver. And it looks like, that may have happened to some extent. I have heard from mostly Western bullion dealers that they still have been doing more buying than they are selling, but that's not the case in the East. The bullion dealers are doing a lot more selling than they are buying. Anecdotally, lineups everywhere: Singapore, South Korea, China, India, and that squeeze. You're right, John. That squeeze is, I think, nearing its end, and that's I think, at least, of what we saw happen late December into January when the price went explosive. And we can talk about supply demand and how that has shifted, and also how the demand profile has shifted and the implications of that. But it's tight. The Silver Institute themselves said over the next 5 years, we're going to not only continue to have supply deficits, but reach a new all-time record high deficit. So even it's looking challenging for the consumers of silver, and it's looking very positive for the producers and the investors. That's essentially the outlook from here, in my view.
That's good that we've got a few explorers and developers on this panel, so I'm sure that'd be good news to their ears. So we're going to explore all of the ins and outs of kind of the silver narrative a bit further over the next 60 or so minutes. But first, I just want to get to know all of our panelists a bit better and get the viewers to get to know you all a bit better. So what I'm going to do, if you're ready for it, is I'm going to call you out and give you each 90 seconds to give us a run through your projects, where you are, what's special about your projects, and so on and so forth. So first up, Jeff. Aftermath Silver is a Canadian junior development and exploration company advancing critical metals projects in Latin America with a strong focus on silver, copper, and manganese. Tell us a bit more about your projects.
Yeah, thanks, John. My name is Jeff Sundar, Capital Markets Advisor for Aftermath Silver. I've had 25 years in the industry in corporate development management and investor relations. So Aftermath symbol is AAG, listed on the TSXV, and AAGFF on the OTCQX. The company's a critical metals focused company with 3 silver resource stage projects in Peru and Chile. Our flagship project is called the Berenguela. It's a silver copper manganese project located in southern Peru. We do have 100% ownership, which we acquired from SSR Mining for $20 million about 5 years ago. So Berenguela is a large 43101 compliant deposit. It has 122 million ounces of silver in the M&I category and 20 million in the inferred, and those aren't equivalents. So the silver makes up about 30% of the deposit value. Project's also got 700 million pounds of copper in the M&I category and 2.9 million tons of manganese. And manganese is going to be a crucial battery metal going forward for electric vehicles. Projects have got good infrastructure. We're located 5 kilometers next to a mining community called Santa Lucia. It's got good rail, road power, and a skilled labor force. Company's fully funded to complete our pre-feasibility by early 2027. Market cap is about $300 million Canadian. We've also got $23 million in the bank. Billionaire Eric Sprott owns 25% of our shares, and we've got good trading liquidity, trading about 2 million shares a day.
Fantastic. Great summary there, Jeff. On to Greg. Metallic Minerals Corp is a resource stage exploration and development company advancing copper, silver, gold, and PGEs at the La Plata project in southwestern Colorado, in addition to high-grade silver exploration at the Kootenay silver project in the Yukon territory. Tell us what's special about your projects.
Yeah, Greg Johnson, CEO of Metallic Minerals, exploration geologist by background. Started out my career with Barrick Gold, went on to co-found Nova Gold Resources. We grew that company from a $10 million company to a $5 billion company today. Went on to co-found the Metallic group of companies, including Metallic Minerals. And our focus was to build on that model that worked so well at Nova Gold last cycle. So we've gone after assets of exceptional scale, so measured in kilometers, with deposit models that really demonstrate a deposit that a major is going to be interested in. Our flagship 2 projects in the company, one is La Plata, which is copper, silver, and we've just added platinum, palladium, and gold to the resource. Grew that by 23% here in a release just out in January. And then our high-grade Keno Silver project adjacent to Hecla, who's going into commercial production. It's now Canada's largest primary silver mine, 3 million ounces last year, and they are ramping up to full commercial. It's their highest grade asset in their portfolio, and Metallic Minerals owns the other half of the district. We tabled an 18 million ounce silver resource there last year, and are going to be having an exceptional, an expanded drill program in terms of resource expansion at the project, this year. So two excellent projects that we see a potential to grow. One that's a primary silver with over 80% value is silver. The other is copper, silver, and PGEs. Newmont is a strategic investment at 9.5%, and Eric Sprott is our largest individual investor.
Fantastic. Thanks for the summary, Greg. On to Darrell. Minaurum Silver is an explorer concentrating on high-grade, 100% owned, production permitted Alamos Silver project in southern Sonora, Mexico, in addition to the Lone Mountain CRD project in Nevada. Run us through your company, Darrell.
Yeah, thank you. As you said, my name is Darrell Rader. I'm the president and CEO and director of Minaurum Silver. We are focused primarily on the Alamos Silver project, which, as you mentioned, is 100% permitted for underground mining production. It is a silver district. It's not just a series of smaller vein systems. We have over 29 distinct vein zones there. We have been drilling for a number of years with the idea to prove that this is a silver district. Of the 29 veins, we drilled 19, 12 of them returned high-grade results, and we're now, in the first part of this year, we advanced 3 to our maiden resource, and those 3 delivered approximately 55 million ounces of silver equivalent, about 65% of that being pure silver at a grade of 320 grams after recovery. So it's high grade, these vein systems are wide, and we're just starting to scratch the surface. As I mentioned, we have this inventory of 12 discoveries. We've only put 3 into the maiden resource, and now we currently have 6 drills turning. We're probably going to drill between 50 and 60,000 meters this year. It's entirely focused on resource expansion to get this resource as big as possible, as quickly as possible. And our plan is to announce a new resource update sometime in the second half of this year. That'll be focused on the first 3 deposits that we put into the resource. We're going to expand those, probably add a few more to that. And the idea is just to keep growing this over the next year and a half and probably start moving into the PEA level of development later this year.
Fantastic. Nice growth story there. Thanks for that, Darrell. On to James from Kootenay Silver, which is a Canadian and Mexican-based silver exploration company actively engaged in development of several major silver projects in Mexico, including the Columba and La Sagara silver projects and the Promontorio and La Negra silver projects in Sonora. Tell us a bit more about them.
Yeah, sure, John. Jim McDonald, President and CEO of Kootenay Silver. We've been focused in Mexico on silver exploration for some time, over 20 years now. We've made 4 discoveries in Mexico. So those four different deposits that total 223 million silver equivalent ounces in M&I category, and another 111 million in the inferred category. Out of that, pure silver is almost 120 million ounces in the M&I and another 83 million in the inferred. So 2/3 of that is in silver. And we've got a flagship property called Columba, which you're looking at right now. We put out a maiden resource last year, 54 million ounces. We see potential here for 100 million ounces or multiples of that. We're actively drilling now. We just expanded our drill program from 50,000 to 60,000 meters on that project. And the other 3 projects we updated our mineral resources on a couple years ago in anticipation of this kind of silver market. And because those 3 deposits at low $20 silver didn't make sense, but when you started to break $30 and $40, they do start to make sense. So now we're reevaluating our other 3 deposits at the same time we're drilling Columba. And those, out of those, we're advancing La Sagara first, where we've got a 52 million ounces of M&I and 11 million ounces inferred. We're doing a PEA. So by the end of the year, we want to be in a position where with Columba, we're completing at least 50,000 meters out of the 60, doing a resource update, making a decision on a PEA, and with La Sagara by mid-year delivering a PEA and hopefully going down the path of feasibility, changing ourselves from a discoverer of resources to a discoverer developer.
Fantastic, thanks, James. Yeah, you mentioned $30-$40. Well, we're a bit north of that as well. So good times ahead. Last but not least, Peter, you're the book author of The Great Silver Bull, and in addition to being a newsletter editor at the Silver Stock Investor, do you want to run us through what you do a bit further?
Thanks, John. So, yes, published The Great Silver Bull back in May of 2022. And the idea behind that was to essentially explain the silver market and opportunities, investment opportunities to investors. So, the book really runs through the history of silver, talks about the macroeconomic environment and why it's important, especially as we go forward and since perhaps the last decade even or two, but definitely going forward. And then I talk about demand supply dynamics on silver and why they're so bullish. Then the last sort of two sections of the book talk about how to invest in silver and silver mining companies, how to build a portfolio. And ultimately, I think we're perhaps a decade off. So, I think this could last certainly for quite some time. But ultimately, I think, and it may play out a little bit differently, but from traditional bull markets. But I think that we will end up at some point several years ahead where we will want to take major profits from this market. But that's quite some time off. And so that book has been well received. It's actually now published in German by a German publishing company, looking at a couple of other publishers as well right now in Asia. And other than that, I published two investment newsletters. The first is Silver Stock Investor, which is a subscriber-based letter. It covers the whole spectrum of silver investments, everything from silver ETFs all the way down to pre-discovery explorers and everything in between. And then we have a letter that we launched a little over a year ago called Silver Advisor. That's a free letter to silver investors. That's supported by the companies that we write about. And we essentially cover all of their news the same day and give followers an opportunity to act on that news. And we explain essentially all the company's material, press releases and developments. So yeah, that's essentially what I do.
Fantastic. Thank you, Peter. So as I mentioned earlier, this is a live panel, and as part of it being a live panel, there's live questions that are also coming through, and so I'm kind of going through them bit by bit as you speak. And so I want to launch straight into the first one to kick off this panel. It's basically from an anonymous attendee, and they've said, do you think we'll see major silver discoveries again, or are most of the big easy deposits already found? Jeff, did you want to take that one?
That's a good question. I think I'd like to pass that to the geological team here, because discoveries are really hard to make, and I think it's better suited for a geologist that's been part of that.
Yeah, great. Greg, do you want to take that one away?
Yeah, I'm happy to jump in there. What's really interesting on the discovery front is that if you look at the current decade, we have many less deposits that have been discovered. Well, we're talking silver, gold, even copper. And there's a reason that's happened. Over the last 20 years, the mining industry has transitioned from the major mining companies doing exploration broadly. When I started out my career, for instance, with Barrick, there were 350 explorationists doing projects around the world. Today, they would have a handful of guys monitoring the juniors. So the industry has evolved to become much like pharmaceutical biotech, where you've got these large companies that are very good at building and operating mines, but they don't do exploration outside of their existing MineX around their existing operations. That means the market has completely offloaded exploration onto the venture stage companies like ourselves. Now, that's not necessarily a bad thing. I think the majors recognized they weren't very good at exploration, so it made sense to rely on the market to pick the winners, so to speak. But when you go through a 15, 17-year bear market, depending on how you count it, and you are not funding exploration, and there's at least a 10 to 15-year timeline from initial discovery through drilling, exploration, engineering to production, we have set up a situation with the lack of really starvation capital that the industry has been through over the last particularly 10 years, where there are not very many projects that are in the pipeline currently. And even if the investors start throwing money at these companies, it's going to take time to make the discoveries that can then advance to production. And I think, to the question about, well, have the big ones already been found? The big obvious ones that tend to stick right out of the ground, there are not many places in the world where you can go and knock on a rock at the surface and find 1,000 gram per ton, outcrop. Our Keno Silver project is one of the few areas where that's still the case, but they discovered it over 100 years ago, right? And it's just underexplored. But in general, the big obvious deposits that are sticking out of the ground have largely been found. And so that means we're needing to bring in geophysics, we're needing to look undercover, we're needing to go to riskier geopolitical terrains in order to find these discoveries. And so I think, my perspective, yes, there's a demand element to this bull market, but this is a supply constrained bull market. Last cycle was 10 years. From 2001 was the low in the cycle to 2011, 2012, depending on which metal you're looking at. I think we're setting up, because of the extent of this bear market and the lack of new supply that can come to the market. I think this is going to be a longer and stronger cycle, and it's going to be a supply constrained cycle. These are a high grade, large silver deposit is a very scarce thing, particularly in a reasonable geopolitical environment that you can actually develop it.
Yeah, you can't move the rocks, unfortunately. So I just wanted to bounce off what you said there, Greg. You're saying that the easily identifiable kind of surface expression ones are gone, and that we're jumping into more of a undercover, using more advanced techniques, geophysics, to find the next deposits. Do you think that uptake and that use of technology is kind of advancing fast enough that we can still find these deposits? Or is it still in a phase where it's not really working yet and we're not bringing the deposits online yet?
I would say that we're early, right? We're just starting to see capital flow back in. But if you look at the number of discoveries, we've just gone through 2 years where there's hardly been a major discovery. And that's rare if we look back at past cycles. So it's telling you something. It's telling you, even though there's good science, even though there's good companies, even though capital is starting to come in, in this last year, it's only been less than a year since we've seen the market turn. Most of the companies, ourselves included, our last resources were at $20 an ounce silver. So it's a completely different market now. There will be money thrown at high quality companies and good teams. And so we will see discoveries, I have no doubt, but it's going to take time. And it's going to take applying those tools. And, I don't think investors should expect to see big discoveries coming to market anytime soon. And companies that are already onto something, I think are really going to be real value for investors. There's one other area that I think shows great promise, and I think some of the companies in here have got this situation. And that is, if you're in a historic district that's already had production and maybe is underexplored, oftentimes that's one of the very best places to go looking for something that along trend in the same geologic context, where you can build on the work of past workers and companies that have been in the area. That is the one opportunity where you may be able to fast track something more rapidly, is in a kind of an established geologic terrain that's already demonstrated those. And I think that's one of the first places that people are focusing on right now.
Absolutely, yeah. I agree with that. It's more of a brownfields approach, but maybe not in all circumstances. Now, I'll throw this button back to Jeff, this next question, because you mentioned before that you've been in the silver investment game for a long time, and you made some mistakes at the start there before you got the hang of it. So this person said, for someone new to silver stocks, what's the main difference between investing in a producer versus a developer? Is one safer than the other?
Gotcha. Well, so yeah, I've been working in the industry for 25 years, investing with an all-in mentality that whole time, and the last 6 years focused on silver. So when it comes to investing in silver stocks, I think it's important to have a proper mix of producers, developers, and exploration companies, but buying cheap is not always better. In a bull market, you might be attracted to any company with silver in the name, but I think it's important to think hard about what assets a company actually owns and what supports the market cap. So I know that sounds basic, but we can get caught up in the excitement when the market's moving. Personally, I favor the small cap silver producers but I do also like the developers as well. The producers are actually selling the product and making profits right now, and the developers are on their way, or the near-term producers. So they can both have direct leverage to a rising price. But I think in this environment right now, with silver at $85, I think the producers will benefit a bit better. But I've had great performance in my portfolio on silver developers as well. So I think a basket is good. So that'd be my answer there.
I might just jump in on that to say we've seen most of the money go into the liquid producer names right now. So investors have done very well over the last year in the producing names. If you look at the venture index, so if you look at the large cap XAU, for instance, it's at all-time highs. So the producers are doing very well. There's still room for the producers to go more with metal prices higher. I think the real opportunity, though, the venture index on the Toronto Exchange, that subset that has 80% explorer developers, would have to triple to get back to its highs from 2007. And what was the silver price in 2007? The gold price, $750 an ounce gold, and sub $20 silver. So I think the producers have been a great place, and I think they're going to continue to perform with the market. So I think that's right on. But I think the big opportunity for investors is in the juniors, because they haven't moved as much as a whole, and particularly I think there's just a lot of of potential value growth, if you will. So the juniors are the growth element of the mining space.
Yeah,
just to jump in there, sorry, John, but we're seeing a very typical mining cycle play out here. So when finally gold took off, silver was been lagging, and only in the last couple of months has it really broken out in a big way, spectacular fashion, as we all know. And so the producers are the first ones to move in that scenario, and they've moved a lot, as Greg's pointed out. And then the next thing that'll happen is that the developers will start to move, and then the explorers at the end of the day. And we're seeing, and he's right about that. So the big opportunity remains in that next tier, which is really the resource companies with resources and developing those resources and moving those resources down the path of development. Then the explorers will start to see some joy as well. Gets back to the issue of supply constraint, because it takes many years to discover things. So the producers have stopped spending money in exploration by and large. Now it's left to the juniors. So the juniors with resources, then the juniors without. There's been no money. In other words, the producers are getting it first, the developers next. Explorers haven't even seen any joy yet. And it takes a long time just to discover something. It takes over 2,000 showings, the statistics say, approximately, to make one mine. And then you got to drill all those. And 10 to 20 years from discovery to production might even be optimistic. And so we're not going to see that supply constraint go away anytime soon, is what that tells us.
I
John,
tend to agree. Oh, yeah, go for it.
Sorry, I just wanted to jump in with a couple of maybe interesting points. Is that I look at this all of this aspect as well, and I agree with both Greg and Jim here. Then, if you look at how the miners, if you just use silver ETFs, the SIL, SILJ, which are the typical ones here in North America, in the last 2 years, they've offered no leverage over the silver price. So you're even with silver. You could have bought either silver or those ETFs and made the same gains. That's not the way it's supposed to be when you invest in silver miners. But that's because we're looking at a certain time frame. And I'm convinced they will offer the leverage they have offered in the past, and you have to be paid for taking on higher risk. The other point that I want to make is we haven't, and despite how much the seniors have moved, I think that even with them we haven't seen anything yet, because I don't believe that the way their profit margins have expanded at $30 silver and let's say an all-in sustaining cost of about $20, they had a 33% profit margin. At $90 silver, they have a 78% profit margin. I think over the next several quarters, we're going to see the market come to terms with that and actually start to price in these hugely expanding margins. Is something else that people maybe should try to wrap their heads around. The producers have gotten cheaper, believe it or not, even as their share prices have moved up. They've gotten cheaper on a price earnings basis because their earnings have gone up so much, and we haven't seen those really reported for very long yet. And so that's the first thing. The second thing is that there's an interesting point made by a fund manager out of London, Ned Naylor Leland, who manages the $3 billion Jupiter Asset Global, Gold and Silver Fund. And he was saying, look, the producers are trading at 2 times NAV. By the way, silver producers trade at 2.1 times NAV, and big gold producers that trade at 1.3 times NAV. So there's a scarcity premium on silver producers. There are so few. And that's one point. The developers are trading at 0.2 times NAV. So to go from developer to producer in this market, you're looking at a 10x. And we haven't even talked about juniors yet. So I think there's lots of upside in all across the spectrum. And I do think, like Jim said, we're going to see this really start to trickle down. We're going to see the big producers at even higher share prices eventually start to use their shares as currency to go out and start buying developers, and then developers will have this this PNAV expansion. They're going to use their share price to go out and buy juniors that have great big discoveries, and you can have some producers that will just skip the developers and go straight to buying these advanced high grade large resources. So those are just some points I wanted to make. I think that the outlook remains very, very bullish in this sector.
Absolutely. To play devil's advocate a little bit though, when I look at the gold sector, I mean, silver follows gold with that everyone knows the ratio there. The producers obviously are flying on the gold front, and the developers are getting a lot of love in gold as well. But it doesn't really feel like, I mean, this gold run's been going for a while now, and it doesn't quite feel like the explorers are getting that attention yet. And if we're looking at that type of time frame to silver, does that mean that kind of the smaller side of town is still a considerable way away of receiving the kind of love that it deserves?
I would leave that perhaps to some of your other panelists to comment on where the potential, how they see the potential for juniors in this kind of market. What I will say is that the same way silver lags gold, and this past sort of year or two has been textbook replay of that kind of action. Silver lagged for the longest time and then vastly outperformed gold last year. To that point, I think that we could see similar things play out with the juniors, but I will certainly defer to your other panelists to give some comments on that.
Yeah, thanks, Pete. Well, you mentioned that explorers that have established resources are obviously getting a premium over the Moose Pasture team. So, Darrell, there's a question that came through here that it'd be a good one for you to jump onto. He said, "Hey, how important is grade today compared to 10 to 15 years ago when it comes to building a new silver mine?"
That's a good question. I think it's something that doesn't really change. I started in the industry when silver was breaking $5, and I remember reading these annual reports of some of the bigger silver producers talking about how their production costs, they're suffering a bit with producing silver at $4.50 an ounce. That wasn't that long ago comparatively, but input cost, inflation, everything has played a role. But even back then, the old saying was grade pays tons cost. And I think one of the things that you have to be aware of in this kind of a silver market where silver's flying, we saw this in between 2009, 2011. As Jeff sort of alluded to, everything with silver with their names starting to get some attention, especially sort of what we used to classify as a kind of the optionality plays, those that are uneconomic in the $20, $30, $40 silver range are now, they're definitely stepping on the gas pedal as far as valuations go. I think where grade comes in, especially, is not so much as that's the sole determinant or factor behind getting a big return on your investment in the market in the silver space. But I think where grade comes into play is what companies are actually going to be taken over in this next sort of market boom that we're entering. You look at, especially in the silver space, Mexico is obviously well endowed with silver. The high grade plays, even we were sitting here a year and a half ago where Mag Silver, Gato Silver, Silver Crest, all sort of single asset high grade plays, they're all gone. Who's the next round going to be? The next round is going to be, if you're listening to guys like Michael Steinman from Pan American, Keith Neumeyer from First Majestic, they have shifted their focus downward, down the production schedule, but they have not moved their eyes from grade. They all talk about pursuing new high grade silver discoveries. What's changed is a year and a half ago, the bigger silver miners wanted to see something in production. Now, Neumeyer, Steinman are talking about they want to see something with a clear path to production. So I think what that means for investors is as long as you're pursuing high grade, I think you're going to have a good chance of, and of course, size too. I think in the silver space, you need high grade and probably size over 100 million ounces. That will attract the sort of the premium offers from the bigger players out there. And not to say you can't make money on the lower grade ones, and you definitely can in this market, but grade is the one that the industry is still looking for.
I'm hearing grade is still king there, Darrell.
Yeah, I agree.
Yeah, absolutely. So we've got another question here. I think this one would be best going towards one of the more, Jeff, if you want to take this one. What's one misconception retail investors often have about silver mining companies?
Misconception. That's a good question. Well, I think once again, I think it's important to have a basket. There's 1,200 companies listed on the exchange, and 900 of them are exploration phase. And I think exploration is the lifeblood of the business, but they're also more riskier. So I think there's only about 100, 150 companies that have a resource of some kind, and only about 50 fit in the silver category. So I think it's important to have a basket. I think these are mistakes that I made in the past where I was highly concentrated in a few single names. So I think it's important to have a basket, and because there's going to be large drawdowns and corrections. I mean, when the market's exciting, it's exciting. We can't foresee a correction, but I think in those drawdowns, if you have a solid underpinning of a resource or production, then you're able to withstand that. So I think that's important to have a longer term view. And I think oftentimes people get caught up in the short term.
Yeah,
Right answer.
I'd add to that too. I really think from the geologic exploration side, it's so significant once you get over that hurdle of a significant resource. So in the silver space, if you've got a system that's got at least 20 million ounces in resource with visibility to over 100, that's a major de-risking factor. And a lot of investors, I think, as Jeff said, there's so many names in the space, they get confused by the guys who are still out trying to find something. They're still doing the wildcat exploration, the greenfields. So for investors to have that basket approach and to be looking at, does this company have at least a significant starting resource and visibility to something bigger? And to second Darrell's comments earlier, oftentimes you want to see something that also has a higher grade zone that could be a starter operation or something. Those elements I think are really important for investors looking at the space. Take a basket, make sure they've at least got a significant resource already and visibility to something bigger, and add to that a team that demonstrates a track record of knowing how to operate in that jurisdiction, has demonstrated they've been able to raise capital, and perhaps they've got a recognized investor who's already done the due diligence. An Eric Sprott or a major mining company is already endorsed it. I think those are all helpful for investors, especially if you're new to the space, because it can be a bit confusing with these three. We've been talking terms and kind of flipping and flopping, but you've got the producers, even the producers, you've got their really large producers. Then you've got your kind of mid-tier and your junior producers, which are smaller mines, often one asset companies. Your developers, and by that term broadly, you have at least a resource that you're advancing through the engineering stages towards production. And then the pure play exploration, they've got a good concept, maybe picked up some ground. They want to drill some holes, but they're not yet over that risk profile, in terms of demonstrating the system actually can make a potentially economic ore body.
Great answer, Greg. You mentioned about the structure of the team versus kind of the geology, and there was a good question that came through asking exactly that question. Which one should I focus on? Maybe I'll throw this one over to Jim. Did you want to take that one? Like, which one is more important, or are they both equally as important as one another?
Well, guys like Rick Rule say back the horse, not back the rider, not the horse. So that's the management team. And because the management team will come up with a good asset, or they'll get a good asset and they do the right things with it to capitalize on that asset. If you don't have the right team and they're still learning, they're going to make a lot of mistakes, then then a lot of things can happen. So you ought to start with that experience, a well-experienced team, lots of depth. Everybody on this panel here their teams have lots of experience right across the board. And I mean, we do. I know we right from prospecting to mine build to mine operations and financing all those steps. So it's really important to have gone through that. So you've made the mistakes already. You know what to do, what not to do, what to focus on. So really backing the rider. You're not going to go wrong doing that. It's a good strategy to have.
Yeah, and then I guess as part of that, as a follow-up question is past history of finding other assets, is that a good thing to look for in your team, or is it the ability to raise money, or kind of like what's the
Well, I think all those things are wonderful to have. If you've got people who know how to discover, have made discoveries, that's great. And if they've done that, they probably know how to finance to get there, right? And so then taking it on beyond discovery to what comes next. I mean, you got to run it through the whole process, economic studies, feasibility, and then if you're making a mine decision, the build, the finance of that, and then the operations. The operations is a completely different skill set. So you need a different team than your discovery team, a lot different team for that. And that's where a lot of companies can stub their toe if they're going to transition from discoverer to a developer to a miner. And that's why a lot of juniors set themselves up to be bought out, because that's a different skill set. And best left to miners, actually.
Yeah, I agree 100%. So,
Jon, if I may, just a quick point I wanted to make is that to maybe extend on what Jim just said, and I agree, the team, because here, let's put it this way, the team, but a team that has proven itself, but that also has significant skin in the game, because if they've proven themselves, they have the history and they can make this happen. If they have skin in the game, they're not going to pick any old asset. They'll pick an asset that has potential. And so those two aspects of the team, I think really covers a lot. You can, if you've got those two things with the team, they're going to make sure, because it's going to affect their pocket. So you can really feel, I guess, obviously there are no assurances, but you can feel, I think, significantly more comfortable if those two boxes are checked off.
And how about in the case of, I've seen some companies where the management is only a couple of percent or even less than a percent, but they've got really strategic shareholders like we've got Sprott on a couple of these or similar kind of names. Does that provide does that kind of deflect from the holding of the insiders, or is it still a necessity?
Well, I think that it certainly helps. You have to maybe look at how they got to owning such a small portion. Was it through inevitable dilution because they went through a few difficult cycles and really needed to do that, to keep the lights on? But certainly, I would agree. If their holdings are low, but they have a strategic asset and they have some recognized large shareholders who really know the sector, that would certainly be, in my view, a bit of a counterbalance to the management not owning as much as perhaps I'd like them to own.
Yeah, absolutely. Dilution, eh? It's a killer. It's a killer.
Sure is.
So for this is more of a towards the developer phase. So I mean, Darrell, you can take this on. For companies in development stage right now, what's the biggest hurdle? Is it permitting, financing, or is it something else?
I would say financing is not the issue, thankfully, for the first time in a very long time. We're sort of at that transition where we're getting to our PEA here pretty soon, but we are fully permitted for underground mining, and part of that came just from our background in Mexico and having been involved in a number of discoveries. We realized pretty quickly in Mexico, and I've been there for 25 years now working. I know Jim has been there a long time too. It's one of these things when you make a discovery, you look at your long lead time items. It always used to be machinery, financing, debt, all this kind of stuff. Now it's really become permits, community relations, things of that nature. So that has been a big priority for us. Thankfully, when we made our discovery, we started permitting at the same time. So now our permitting is actually ahead of our development. But in this market, permits are number one, I would say. Number two is probably procurement of labor, especially experienced operating teams. Thankfully, with one of the things we did with Minaurum is we have found the ability of hiring teams from recently acquired companies has been a pretty attractive way of getting teams together. For instance, for Minaurum, about a year ago, we acquired the entire resource modeling team of Silvercrest. Simply because these were young, well-trained geologists, had seen hundreds of thousands of meters of drilling in their careers, but they didn't necessarily want to work for a Kerr, for a large Mexican mining entity. And you have to be a bit creative right now is to find that labor in order, as Jim said, to take you along the development curve, because going from exploration to development requires a somewhat different skill set. Going from development to production is an entirely different skill set. So you have to really pick and choose where you find these experienced guys that you can bring on and that can help your asset development past where it is today.
Yeah, very, very interesting. The permitting does seem to be becoming more and more of a center stage across all jurisdictions, not just like tier one, whatever that term means. But yeah, that's very interesting to hear, and obviously securing that team. But I want to shift this one over to Jeff. This is another question from Tina Nowak. Do you see more value being created through takeovers by producers or by actually building the mines yourself?
Well, I mean, I think some of the last 6 years I've been very focused on the silver side, and 95% invested in the equities. And I think the companies that have advanced towards production and got in production performed the best over the last number of years here. So I think if you're able to do that, I mean, prior to the last few years here, these companies were underfunded, and we've just seen the flurry of capital fly in and help these management teams advance their projects to production. So I think if you can take it as far as you can and take it to production, I think there's great value there. But that being said, we've seen some great wins in the takeover side with Gatos and Silvercrest and also Mag Silver the last few years. So that'd be it.
Fantastic. I've had a few other ones that aren't questions, but they've said, "What a lineup!" Exclamation mark. So there's a compliment for you all. So if financing isn't the issue, here's another question. Maybe Greg, did you want to take this one? If that's not the issue, then what is the biggest issue for a company like yours?
Yeah, I mean, I think Darrell's point about permits, especially if you're working in, a higher regulated environment like we are in the US and Canada. Permits are something, social license, doing that community outreach, establishing, your preseason meetings with the community, your postseason meetings, and communicating what stage are we at and what are the next steps. It's super important, right? If you've got indigenous populations, that you're engaging with them as well and bringing in, their perspectives on projects. So those are important things that need to be done if you want to successfully take a project from early stage on towards, production. I think I would echo the people part. In addition to a lack of capital investment over the last 15 years, we've seen a lack of investment into university programs and students graduating with degrees, whether it be in geology and engineering, mining, related skills. So we're looking at a situation now where, okay, capital is starting to flow, but guess what? Finding those people to be your drillers and to be your exploration crews and stuff is a challenge. And it's going to be something that we're starting to really see a need for a significant expansion. Many of the drill contractors, they're getting tapped by the big producers to come in and drill around their mines. And so it's getting harder and harder to secure your drilling. So, these things that are, in addition to the funding, we've come out of this just terrible bear market over the last 10 years. But now that we've got access to capital again, it's going to be these kind of everyday matters, getting the right people and being able to move forward and keep, your pathway going ahead at the time that you'd like to be able to keep your projects moving ahead.
Yeah, there's the time issue is obviously a big factor in the equation that's hard to measure.
It is, and it's probably one of the things that most investors don't appreciate is probably the single biggest risk for any company is time slippage, right? We will go out there and we'll say, hey, we think we can do this in this period of time and deliver that PEA or that pre-feasibility. And either because, you're making we've found a new zone and we want to drill on that or what have you, but you tend to see these times slip. And I would point investors to, if you're taking an investment, particularly at the, resource or PEA kind of stage, recognize that, one of the biggest risk factors here is going to be timing risk. How long is it going to take for this company, to move this asset, forward, and to understand that this isn't something that is a short-term investment. Investors should be thinking about a 2 to 3 year timeline or horizon on most of these things for us to do that work that creates that value. And as Peter mentioned earlier, I mean, it can be a 10x from resource stage to feasibility. So there's a huge amount of value to be created, but it's not something that's going to happen overnight. And the day-to-day, surprisingly, a lot of investors will ask, why is the company value going up and down daily based on the value of silver? Because you guys aren't producing yet. And so one of the things that we often talk with people is, well, even though we're not at the production stage, in a way, the market is treating our valuation in the marketplace as a discounted future as if you were in production. So we are actually mark to market every single day based on what happens in the silver price, with investors factoring in the fact that you're still a number of years ahead until you're in production. But that's part of what goes into how you value these companies.
Fantastic answer. If we shift back to more of a macroeconomic view now. Sorry, the question has just disappeared. Anyway, I'll summarize it. Peter, yeah, he's basically said because so much of silver is tied up in copper and zinc and lead miners, do you think that there could be a point where the silver price comes high enough that it'll significantly affect the way they think about it due to the silver aspect? Or is this always going to be a separate thing that they don't really talk to each other?
So if your question is, will producers whose silver output is a small byproduct, essentially, will they change how they act or how they think about their asset? Will they try to ramp up production and so on? If that's your question, my answer is it's going to take, I believe, a much higher silver price, because it will, in terms of, say, ounces, it will remain small. In terms of cash flow, that's where it can start to make a difference. But as the rest of your panelists will know better than me, it's quite difficult to expand your production. It's quite difficult in many ways. You have to get the permitting. You have to grow the resource. You have to get the permitting. You have to finance the expansion. It's all of these aspects of that. So, yeah, I mean, and actually, I'm thinking back to something Greg told me several years ago, which I have not forgotten and have repeated a few times, which is that when your metal price moves up. So we're talking about silver. If you have a polymetallic deposit and silver's a byproduct, or even if it's even if it's a primary product, maybe more so, primary silver mine. If the silver price moves up significantly, you can have management say, well, we've gone from $50 silver to $100 silver, and I can easily access this part of my deposit that is lower grade, and I can produce from there. And if I produce from there, I might produce at half the amount of silver, but I'm still making the same dollar profit. And so that's a real quandary for the market, because when you think that the silver price will help bring more silver to market, it may actually help bring less silver to market, which is completely counterintuitive, but if it's explained properly, it does make sense. So I certainly give credit to Greg for that concept, and I believe it does play out sometimes, and we could be in one of those times.
Very interesting. Well, I bounce that one back over to Greg then. If we maybe dig a bit deeper into that, as far as the mine planning around these fluctuating metal prices.
Yeah, for sure. So the context there that Peter is talking about is your mill is a fixed throughput of tonnage that you put through your mill. You have a grade or a metal concentration for each ton of ore, and a ton is roughly a meter or three feet on a side to visualize what a ton is. So you've got a mill that produces, let's say, 1,000 tons a day. A high-grade silver mill might be on that kind of order. And so you're putting a certain concentration through that mill. Well, if the price of metal doubles, you can put half the grade concentration through that mill and still make just as much money. And so what a mine will do every quarter at least is they will adjust based on metal prices the value of their ore blocks. And they will make decisions, and maybe they'll decide we want to keep our margins high. But I would guess over the next couple of years, if with these metal prices at this level, and if we just even have flat metal price environment, you will see companies adjusting their mining, and they will be saying, this is what we're targeting for, the earnings for the mine, and you will see grades come down. And that means when grades or concentrations come down through a fixed throughput, you're going to have actually less metal produced with just as much profit for investors and shareholders. But really counterintuitively, that means producing less metal for the marketplace.
I've also seen miners do the opposite. When when the price is high, they just want to smash the high grade areas to boost the balance sheet. But I guess it depends on what they're trying to do. But yeah, I found that extremely interesting. I hadn't thought of it that way. That they actually shift to the lower grade ore and keep that upside in the future for rainy days in the future. So
One way to kind of think about it is if you want to visualize most ore bodies, they're going to have a higher grade core. So almost like a dartboard, rings going outward. And the big risk in the tough parts of the cycle when metal prices are low is people will high grade and they may strand ore that they can't go back and mine. That's often what happens when they're under real price constraints. But when those prices come up and now, oh, we don't have to rush into the high grade in this part. We can stay here and mine this area, a bit broader area, and take more of that metal value. The other thing that's quite counterintuitive, as metal prices go up, a company's inventory goes up, right? What's economic to mine? And this is part of the reason, as Peter was mentioning earlier, it's part of the reason why we can see, if you look at cycle top to cycle bottom, one of the most important things for investors to recognize is, where am I in the longer term cycle, right? We've just come out of one of the longest bear markets in the last 100 years, right? So it's an excellent time for investors to recognize, these are really low values, whether we're looking at producers, developers, or explorers, because of that cycle. With that context, that means that as a company today, they might have been worth $10 at the top of the last cycle. Today they're at $1. There's been that kind of compression, and part of that is this fact that as the metal price comes down, you actually have to shrink your inventory. You have to say these ore blocks are no longer economic, and so you see companies have to actually write down and say, oh, our inventory is now this. As we go up in price, you'll see companies be able to say, just because of metal price change, we've gone from $20 now in silver to $80. There's going to be companies that are going to show a substantial increase in resources just on metal price, because now blocks that weren't economic before are now able to be economic. And so you're going to see a lot of companies expanding resources, simply to reflect the real economics today, that we've seen silver price, quadruple effectively in the last year.
I agree, Greg. One of my kind of personal investing criteria for a while that worked quite well for me was trying to find areas that had historic technical reports or feasibility reports. And obviously, just like you say, the market hasn't quite realized yet that asset is running at a $10 per ton, or in the respects of gold, like $1,000 an ounce situations. And all they need to do is just rerun the numbers, and all of a sudden their resource doubles in size. So yeah, I love those ones, but it feels like everyone's getting up to speed with their feasibility studies now. So there's not too many of them left.
Which will be great for investors, right? Because suddenly there'll be a flurry of updated technical reports coming out as people rethink their deposits. This is also one of the reasons why it often takes decades for projects to move forward. The geology is recognized. Oh, this place is really conducive for silver, and maybe other metals. But let's go back to past cycles, at $5 silver or even $1 silver, if we go back even further, those things weren't economic. But today, if we look at this price, there's going to be deposits that were identified, even drilled, maybe even had studies that were done, but they weren't quite economically strong enough to go into production. And you're going to see companies be able to go in and say, hey, we can take that had those great companies that worked on it in the past and advance it. And, in fact, when I was at Barrick early in my career, we did a study. The average mine in North America has 6 different companies that work on it before it becomes a mine, with company 1 and company 2 builds on what company 2 did, and 3 and so on, right? Is working on these things. And that's the more norm than the one company makes the discovery and takes it to production. In our industry, is to see that long history of work, that recognition of value. And then finally, one of the companies, because of metal prices and maybe economics and the geologic model, is able to put something together that can then make it over the hump and get into production.
Yeah, that's a tough one though, isn't it? Because if you've had something that's changed hands 10 or more times, then it can start to be a red flag as well. But that's very interesting that you say that. Yeah, 6 is the magic number. Then
it can't be. It can be less, but it's the rare case. It's the rare case where the first company to discover it pushes it forward all the way.
Great.
Mining cycles play a role in that too. as you said, the mining cycles play a role in that too. So
Absolutely. Yeah.
sometimes it's just the timing, and one company gets lucky to step into a strong market where you can get financing readily for your project and get it up and running before you get a cycle downturn. But there's a lot of things go into that, and a lot of reasons why numerous companies walk through a property before it becomes a mine.
And it's not a bad thing necessarily. I mean, it could be a situation where there's just not something there, but there's just a lot of smoke. It's not a bad thing to see that, this is the third or fourth company working on a project because, as Jim said, the cycle is a factor, but also a risk. You go in and as a company, you pick up a new piece of ground and you drill 10 holes. They're your best 10 holes and you can't really see an obvious place to continue. It makes sense for you to say, you know what, we took our best shot, didn't work out, we're moving on. And that's often the history you'll see on these is, you're coming in, as company number 3, 4, or 5 oftentimes, and looking back, and each company did good work that built on the prior work. And these are real challenges. The exploration business is like a puzzle. And we come in and we have to, the geology, we can't move the deposits. The geology is what the geology is. You can't see under the ground very well. So we have to drill these holes and do this work and use some of the visualization software to figure out how do you advance this and how do you understand what the geometry is underground and how you might mine it. But that's actually, I think, part of the interest that investors have is it's a really interesting business. It's an interesting industry. The exploration process is exciting. And it's a true value creation process.
Great answers. Great. Yeah. If we shift over now, you were mentioning the majors there and the kind of the size requirements around that. But I'll throw this one over to Darrell. Darrell, why aren't we seeing 100 to 300% takeout premiums just like we saw in the 08 to 11 bull run, like Fremont Gold's takeout by Newmont, if memory serves?
I would say I think we're in a different part of the cycle at the moment. We're not at that extremely frothy cycle where you saw, of course, Kinross do their major acquisitions in Africa, right, in 2011 at the top of the market. I think, talking to a lot of majors pursuant to what Peter mentioned on valuations, net asset valuations, a lot of the majors realize they're trading kind of at peanuts as far as valuation metrics. So they're not as willing to give their undervalued stock out for what you believe is your undervalued stock. That being said, in the silver space versus the gold, I think traditionally we have seen pretty decent metrics. If you look at Silvercrest, MAG, Gatos, just the last 3 ones of note that were bought, yeah, you're seeing sort of 50% premiums, not much higher than that. I think that's just a factor of the market. We saw takeovers. I'm thinking like 2006 and 2007, we saw takeovers that were quite often in that range. Of course, 2008 was a bit of a different year, but in 2009, things started accelerating. And yeah, by 2010 and 11, it was consistently 100% plus takeovers. So, I'm not a big charting guy. I know Peter's a lot more on that side, but my view is we're yet to come into that stage, but I believe we will come into that stage, and that stage is probably still a couple of years out from where we are at today.
Great answer. So I guess there's still a lot of room for some upside here. They're obviously not investing advice for everyone out there, but in wrapping this up, I just wanted to say thanks to everybody. It's been a really good mix of finance and technical and forward looking and all the rest of it. And there's been a few really good comments come through. Just want to throw those out there. They said learned so much and great panel. So take my hat off to you guys for running us through that, and look forward to talking to you again sometime soon.